in my mind, I think the insurance is important, but I wonder if there is a level of false security that it might provide of what the implications are if that project doesn't progress all the way through to receiving its corresponding adjustment. And so what does that mean for, as a project developer, as a country, as a buyer within that market, how do you think about managing for your exposure? And I think it's a little bit more complex than just having the insurance in place. I think it provides people with a level of comfort, but the question in my mind is, does it actually solve for some of the risks that you might be exposed to? And so that's where I think a lot of those conditions precedent that are being built into contracts and the way that people are contracting and who they think is their counterparty, all of that stuff becomes really important.
So welcome back to This Week in Carbon. My name is Rene Velasquez. I'm filling in for our host, Eddie Smith, and I'm really delighted for the conversation today because I've got a good friend of mine, Stephanie Russo, joining me. Steph is at Pollination, one of the smartest and most brilliant people in the market, and I happen to call her a friend. Steph, welcome to the show, and I'm really excited to have a conversation with you and just to learn more about the type of work that you're doing at Pollination and sort of the things that you're seeing in very important pockets of the market. I know you're not across voluntary as much as maybe you were in a previous role. So keen to unpack some of the more compliance related markets that you'd focus on. Welcome to This Week in Carbon.
Thanks for having me, Renee. And it's always great to get to spend time talking to you about what we see kind of in the market and sharing our different perspectives on things that are happening. There's never a dull moment in the carbon market. A lot of fodder for This Week in Carbon. So
Yeah. There's definitely not. That's one thing I say to my team and to other folks in this space. Like, it is never a boring market. It's always something happening. Something's changing, some new policy, headwind or tailwind, and people must adapt. With that kind of context, can we talk about Australia? Obviously, you're based in Oz, and you're expertly positioned to talk about some of the dynamism in that market. It seems that there's been some changes where it was pretty steady for a while. Can you give us a little bit of context about what's happening in Australia as an advanced economy that's trying, with advanced NDCs, et cetera, and how it's trying to advance its carbon pricing systems?
Sure. So, I think it's, as we think about carbon markets globally, I think sometimes Australia gets a little bit kind of forgotten for the role that the carbon market plays. It's really one of the most mature carbon credit-based markets globally. So for those of you tuning in who don't know much about the Australian market, like many countries, Australia has taken a bit of a hybrid approach to the way that they're looking to meet their climate targets. And so that includes rather than having an ETS, for example, we have a system in place where there is a cap on and baselines that are provided to certain heavy emitting sectors. And as part of being able to meet their obligations under that compliance mechanism, it's called the safeguard mechanism in Australia, we also have a complementary carbon market. And so those entities that are covered by the compliance market are able to use Australian Carbon Credit Units, ACCUs, in meeting their obligations. And the ACCU market has been around for more than a decade in Australia, and it's actually quite an interesting evolution. So when the Australian Carbon Credit Scheme was introduced, the predominant buyer was the government. And so it was set up as a mechanism for the Australian government to be able to purchase emissions reductions and removals, so they could use that for their own target. And over time, it's really transitioned. So it then went to a period of time where you still had that government purchasing, but you saw a lot more voluntary demand coming through from Australian corporates, as we saw a lot more consumer pressure, shareholder pressure, stakeholder pressure, people setting net zero targets. There was a lot of voluntary demand that then came into the market. And we're now in kind of the third period of its evolution where the predominant demand is coming from the compliance market. So coming from the safeguard mechanism, coming from the ratcheting that is required for those 200 plus heavy emitting facilities. They need to improve on and reduce their emissions year on year. And one of the mechanisms to complement that decarbonisation is the use of the ACCU market. And so it's interesting to see that evolution. And I think it reflects a little bit of the evolution that we've seen globally as well. But it is a really interesting and quite mature market. And there are a lot of parallels that you see between some of the trends in the international market and also what we're seeing kind of domestically.
Yeah, no, that's great. Thank you for that context. The ACCU market has also been, well, I won't say volatile per se, but it's come off the boil in terms of pricing over the last 6 months or so. And with those sort of phased sort of, or transitions, let's call them, as you kind of alluded to, how is that affecting pricing relative to the demand? Obviously, I remember a time, like you said, in that second kind of transition, where there was a lot of demand coming in from corporates for substantiating voluntary commitments, and that domestic kind of support base was pretty significant. How do you see that today?
Yeah. So, I mean, the biggest shift is that the predominant source of demand in the market is now coming from compliance. So overwhelmingly, it is those entities that are covered by the safeguard mechanisms who are required to or are using ACCUs in the market. One of the important dynamics, I think, if you look at the history of pricing, is that just over 2 years ago, the safeguard mechanism was reformed. And when that reform took place, they tightened the baseline. So the baseline is essentially sets a cap or a limit on the emissions that those facilities need to meet. And that ratchets and declines. It's just under, it's 4.9% year on year that each of those facilities, their baseline will decline, which means increasingly they need to reduce their emissions or they need to be using ACCUs to meet that obligation. I think what that has meant is for the first couple of years, there really hasn't been seen that there's a supply shortage in the market. So we're seeing increasing demand coming because of compliance markets, but at the same time, there's a lot of historical supply that's sitting there in the market. That's really starting to shift. And so there's been a number of changes in terms of the methods that are eligible. So there's been subject to a level of kind of scrutiny like we've seen in the international market. As people have looked at those methods, the government's been through a process and the government runs the ACCU scheme in Australia. So they've reviewed a number of the methods and they've refined them. So avoided deforestation is no longer eligible. There've been the HIR method, human-induced regeneration, that has now closed. So existing registered projects will be able to be issued with credits, but no new projects can be registered. Historically, human-induced regeneration and landfill gas were the largest sources of ACCUs into the market. Going forward, there is a bit of a gap and there have been some delays around those methods, which means that the pathway for supply is looking more constrained than it would have looked historically. And also as those compliance demands and that ratcheting starts to really bite, you start to see the fundamentals of supply and demand really starting to play out. And so while prices have been kind of relatively stable, you do see a peak like we see in most of the carbon markets that aligns with particular reporting periods. So to meet your obligations under the safeguard mechanism, you need to surrender those credits by the end of March. And so what that means is you see peaks in prices in kind of Q4, Q1, and then you see a drop off as that compliance demand falls away. So I would say from a pricing perspective, looking at it on an annual basis is probably better than kind of looking at it just in particular 6 months blocks, because there are that kind of cyclical nature.
Peaks and troughs.
I think the other piece that's really interesting in the market is I think the presumption in the past for a lot of companies has been that they are able to access the sorts of carbon credits that they want at the time that they need. And so a lot of purchasing, and this isn't an unusual story in carbon markets, but people have looked at and done a lot of spot purchasing, for example. And so they bought credits on spot. They're able to get the access when they need it off the back of their reporting. It hasn't been a challenge for them. Prices, as you say, while they've steadily increased over the kind of last decade or more, they've been relatively kind of stable over the last couple of years. That's starting to change. And so a lot of clients that we're working with are thinking about, actually, maybe it won't be as easy for us to be able to secure the supply that we need. And also, how do we manage for our exposure from a price volatility perspective? And so what doesn't show up, I guess, in some of those spot prices and the price forecasts is that people are starting to do more forward offtake agreements. We're starting to see people come back into the market who are thinking about how they make equity investments, that dynamic is starting to come back into the market again.
That's interesting. And so obviously, is the market long-term though constrained in terms of the supply? And is that what's driving a lot more of that forward purchasing, or is it a selectiveness around the methodologies that are coming through? Like you said, effectively, there's been some methodologies that have dominated the market historically that effectively now retreated. What's the sort of the thesis there?
Yeah, so I think historically it hasn't been supply constrained. I think changes to the eligibility of particular methods and then the delay for new methods to come online means that there is, a predicted supply shortfall coming. And particularly really from kind of 27, 28 is when people are particularly concerned about whether or not they'll be able to access the supply that they need. I think there's definitely an element of which methods. And so people are particularly interested in making sure they're getting access to ACCUs that are from methods that they know will be usable in the future, because if you have a compliance obligation, you want to make sure that whatever you've purchased, you'll be able to use at a point in the future. And so people are thinking about that balance between that supply security, but also of particular methods in the market. So that's
Hmm.
definitely an element of it. I think the other part is price. And so if you have a compliance obligation, some of them are pretty large, and you look at, any of the price forecasts out there, in all scenarios, even if you take a really conservative view of price, there's significant price rises that are expected in the market. And so people are trying to get set before they're exposed to those particular price uplifts. And I think what's interesting is there is a bit of a release valve built into the market. And so when it crosses a particular price threshold, it's around $80 at the moment, so it's indexed. The idea is that the Australian government would release and make available from its reserves credits into that market. They're only sitting on a relatively limited pool of supply themselves. And so while that might take the pressure off pricing for a period of time, I think it's a bit of a misconception in the market that it acts as a cap. And so in actual fact, what it will do is just kind of slow prices for a period of time. And it's now looking like probably post 2030, but it will pass that price threshold. So that's significant price increase from where we are in the market.
Yeah, yeah. Okay, that's interesting. Yeah, I guess one other question that I have for you is around the political risk and ultimately the durability of political systems. I know it's hard to kind of crystal ball gaze, but how durable is a safeguard mechanism in your view? And it's certainly just across election cycles. Is this a politically hot topic or button in Australia?
Yeah. So, I mean, it's interesting. I think if you have been in Australia and involved in carbon markets over, many years, like we both have
I,
been
I
in
ask it,
carbon
it's a bit of
markets
a
for a
loaded
lot of their
question.
career.
Exactly. I ask it because I remember all of that sort of starts in 2007 and then 2012 and so many political changes and carbon was always very loaded. It seems that that's sort of dissipated though. So what's your thoughts?
Yeah. So I think that there's probably a little bit of, I don't know whether you can call it collective, like carbon trauma that exists still in places around the market in Australia. But I actually think if you look at the fundamentals of how the market operates, the infrastructure, that's been relatively stable. And so that's why I kind of like to tell those stories of these kind of three phases of the market, because what's been consistent is the role of the ACCU and kind of where it sits there. Obviously, things have shifted pretty substantially in bringing in that compliance mechanism, but I do actually think that there's a level of policy certainty, particularly out to 2030 in Australia, and that's a pretty new dynamic, and there's a few reasons for that. In the last election, so in the last federal election last year, there was a really overwhelming majority that Labor, the party that is in government, when they were returned. And what that means is that based on the numbers, it would be highly likely that they will have 2 terms in government, because it would be very challenging for the opposition to be able to form government based on the number of seats that they have. Obviously, I'm not making any projections about what will
Yeah,
or
you're not a
won't
political
happen.
pundit.
Yes, but it's pretty unlikely that they won't get 2 terms of government. So what that means is, given the election was in 2025, they get 6 years in government. So that takes us to 2031. So that's actually a pretty significant period as we think about 2030 targets and those sorts of things. The other interesting component is that Australia set its next NDC, so its NDC out to 2035 last year, and that sets an increasing level of ambition for Australia in terms of its climate targets. And the key mechanism that Australia has in meeting those climate targets is to use the safeguard mechanism. And so it means moving from kind of 4.9% year on year baseline decline for those facilities who are covered to something closer to kind of 6 to 7% to be able to meet that 2035 target. That's pretty substantial. It's also not a huge amount of time to get out to 2035. And so given that the safeguard mechanism and the carbon market are one of the predominant tools, what you can see is the Australian government then really embedding that architecture post 2030 to get to that next set of targets. And so with the clients that I'm working with, many of them are safeguard mechanism liable entities. They're really thinking about not just out till 2030, but 2035 and what that means in terms of, and are fully expecting that that target will then be reflected. There's a safeguard mechanism review happening this year that will then be translated into policy and legislation post 2030.
Yeah, that's really interesting. Okay. It's a
And that's
fascinating
pretty unique,
context.
right?
Yeah, that is
If
very
you
unique.
think about other countries and the policy kind of, I think
There's
I've
a lot
been
of,
saying we have a level of policy certainty, and people kind of look at me and like, actually, if you look at the fundamentals around this, you really need to be thinking longer term than we have been in the past. I think it's really starting to become embedded and entrenched. It's not without challenges like most markets. There are still, I think, some remaining concerns around quality and integrity in the market, but I think a lot of those have been addressed through a pretty substantial review process.
yep.
And so really it's now about how do you kind of bring people back into the market? How do people plan for and secure that supply? How do we bring on methods and more supply into the market? All of those sorts of things to make the market really function well.
Yeah, that's very interesting. Can I use this as a sort of a natural pivot? Because obviously embedding the policy piece as a result of the NDCs now kind of brings into question around other compliance markets that are in existence right now, where there's this intersection with governments and sort of their capacity to sort of operate. And the first one that comes to mind is Corsia. I know you're also across Corsia quite a lot. And there's, I spoke about it last week with Valeria from Available, but I'd love to do a deeper dive with you around the actual dynamics of that market. It's a market that, there's still some sort of questions around the implementation of compliance across certain jurisdictions. There's certainly no penalties right now for non-compliance in the first phase yet. There's a couple that have sort of floated it, but overall there's not. And so there's not sort of this fire at the back of the airlines, but we're seeing a lot of new supplier entering the market in the last couple of weeks and sort of certainly this year. And we're also seeing more and more participants starting to look to structure deals out on the forward curve, which is a sign effectively of the approaching compliance window, which is January of 2028. But within all of that backdrop, analysis shows that essentially the market is constrained with regards to supply, and that a short squeeze is coming or is looming. How do you see Corsia more, like, let's just talk about it structurally and in terms of the supply demand dynamics, and then I want to dive into the bottlenecks, specifically the LOA corresponding adjustment bottleneck, and then also to a lesser extent the insurance side of things, which is a requirement for many of the voluntary units transitioning into essentially Article 6 credits. You take your pick. What do you think?
Well, I think they're kind of interrelated. I think it's interesting. There is a bit of a challenge and a bottleneck on both the supply and demand side. It feels somewhat like a little bit of a kind of game of chicken in some ways, because you have many of the airlines who I do think are genuinely taking it seriously. And we've worked closely with a number of airlines internationally as they think about their Corsia obligations and where they source those Corsia credits from. And so they are taking it seriously and thinking about how they meet those obligations. But as you point out, there is a policy challenge on the demand side in terms of what are the implications of this? What does this look like in terms of the translation into policies by countries around the demand side? But I think increasingly the area that I'm quite focused on is the supply side, because to make the system work, you really need to be having the supply of Corsia credits into the market. And at the moment, there's a really large bottleneck that exists, particularly around governments providing corresponding adjustments and letters of authorization to allow those credits to be used for Corsia purposes. And one of the challenges there is governments really wrestling with what is the appropriate role for carbon markets in terms of how do they use that to meet their climate targets? What percentage of their credits should they allow to be exported out of their country that will then mean that they can continue to meet their NDCs? How do they use this as a mechanism for them to generate and attract capital into their country to support them not only with their climate mitigation and adaptation and their climate goals, but also how do they use that for broader development aspirations? And there are a lot of countries who are interested, but obviously you want to make sure you get those settings right, because there obviously are kind of implications if you don't get those settings right as a country. And it can be quite material. And we've obviously seen some recent examples in the market of, we've seen with cocoa networks who had really great relationships in country, and Kenya's kind of changing of position and their interest around how they do that has posed a challenge for them in terms of those letters of authorization. So increasingly, I think that there is an opportunity in the market, I think, to think about how do we engage with, on the supply side, those governments to build out their capacity. And interestingly, we did some work last year with the Madagascan government, working with them to really understand where this could fit. They were interested in engaging the carbon market. They're willing to provide LOAs. They have provided LOAs to WEACT and Korean Carbon Management, who have a cook stove project there. They're interested in doing that, but they wanted to make sure they got the settings right, and also that they didn't overcommit themselves, because there's a huge amount of reporting that you also need to do. And no one wants a paper LOA that doesn't go through those next steps. That's where, insurance starts to kick in. So I think that there's an opportunity in the market to really be engaging in and thinking about how do you support those countries as they develop out those frameworks. And increasingly, what's interesting is we're seeing those who are buyers or those who are project developers are the ones who are really interested in putting some money behind and supporting the development of those frameworks. And that obviously needs to be done in a really careful way, so it's not, seen as them trying to influence the way that policy is developed.
Exactly.
But the reality is there's not a huge amount of money coming from some of the other traditional sources to support those sorts of activities. And those countries need the money so that they can get that support to do that policy development.
Yeah. It's a really interesting point. So effectively, the onus has fallen onto the project developers to help to try to provide the lubrication in that system. But oftentimes they're not well equipped. So great that they're putting money towards sort of a capacity building initiatives, et cetera. But like you said, that's typically the domain of multilateral banks, DFIs and other governments as well, donor countries as well that could support that. But it is interesting that the capacity at the country levels is just so varying. There are countries that have some capacity and already systems in place and legislation and a clear delineation across which departments this falls under, whether it's finance or environmental, et cetera, and other countries where they just don't. And so there's this, like you said, a stasis. The default is we're worried about exporting any carbon credits because of the impact that it will have on our ability to meet our own NDCs under Paris. And so there's this inherent tension, which is by design. Let's call it for what it is, right? Because the corresponding adjustment is essentially a penalty to the exporting country to make it more that they're effectively selling some of their supply, and it makes it therefore more difficult to meet their NDCs. It's been borne out, like you said,
opportunity,
in patches.
I think. Yeah.
Yeah, sure. Please. I want to hear the opportunity.
If it's done right. So I think this is the, as you say, there's a bit of a trade-off. But if you get those settings right, you can, for example, that's a mechanism. If you have policy certainty, if you have really clear rules and ways that you intend to engage, criteria around when you will and won't issue an LOA, for example, that makes that quite an attractive location for a project developer to be operating, or for, we're talking about Corsia in particular, but obviously all of this infrastructure also applies to Article 6 more broadly. So it also means you're an attractive investment location if you have all of those settings right. And so you can be attracting that investment in, which helps you in terms of meeting your climate targets. But the other component of that is
just by leveraging the private sector in that context. We're able to attract international capital to develop projects on the ground, which means employment opportunities. It means investment into systems, infrastructure, et cetera. And ultimately, the cost of doing that or attracting that capital is the export of the emission reductions that are generated through those activities. So it's a win-win across the board. But I don't know how many
Also
countries are
charging
embracing that.
fees for corresponding adjustments. And, if you think about that, even if it's a $1 or $2 fee, some countries are charging $4 per ton. If you're looking at a project that's issuing 2 million credits, like that adds up quite quickly. And that can be
Yeah,
really helpful in terms of supporting what are historically pretty underfunded departments or governments
no doubt.
in the activities that they're doing. And so it really starts
I
to
completely
change the
agree.
way that capital gets channeled if it's done well. But,
Yeah,
who's advising these
yeah,
people? I mean, we're advising some of them, but I think there is a need for that support. And a lot of people thought that would come through, around Article 6 and that infrastructure. And some of that has been there, but I think there's still, a need for more of that to happen. And now we're starting to see that being a fundamental bottleneck for Corsia in the market. So it does
yeah.
then start to impact on how all of these systems will actually operate or work.
Interoperate. Yeah, no, absolutely. So you're absolutely right. A couple of weeks back, I was in Singapore at the NUS, National University of Singapore, and they hosted essentially or convened a group. I think it was like 29, 30 countries that came in, and folks from different divisions of the government, and the view was to build that capacity, to give them the ability to understand, like you said, and the framing I absolutely love, which is this. Think of carbon as an export commodity. You're now you have the access or the ability to export these tons into markets like Corsia or under as Zitmo's under Article 6, and you can essentially start to create a new revenue stream for governments, which are already stretched with regards to their own finances. And so I think that there's an understanding of that. I just think the operational component is where the rubber's not meeting the road effectively there, or to use a very cringy Corsia methodology, there's no takeoff. But so the one thing that I find interesting, and you referenced sort of pricing around what would be effectively that export license, the corresponding adjustment piece, it seems to be fairly low, and I don't think that there's any really adequate price discovery mechanism that's yet in place. I think many of those prices are dictated in bilateral terms. Effectively, the Click Foundation, Switzerland, effectively sets a price around what that ought to be, and then that just becomes a de facto price. And obviously, project developers have a disincentive for any increase in corresponding adjustment because it leads to a materially more expensive credit. Not revenue to them because they've got a base cost of the carbon credit, but then the corresponding adjustment ultimately to their buyer on the other side. So all parties are invested in keeping the CA cost as low as possible. But I think that that's an opportunity for actually help overcome the hesitation around exporting the credits, because if there's an export market that is willing to pay a premium, and I think in the case of Corsia, there is a market that's willing to pay a premium, then there should be some elasticity with regards to that price as it relates to the ability for the host country to replace those tons essentially on their ledger. Have you seen anything like that where there's some sort of discussion around a floating price or some sort of price discovery mechanism? You see it in bond markets, right? Where there's a discovery price there. It doesn't seem like that exists with regards to corresponding adjustments.
Yeah, I mean, I think the price discovery component for many countries is looking at what others have done. So many countries have publicly disclosed what they're proposing to charge. But ultimately, where you set that is determined by a few different factors. And I think there's a really interesting component. We haven't talked about insurance yet. I know we'll talk about insurance. But if you're thinking about you have the cost of production of your carbon credit that a project developer is facing, you then have whatever your fees are in country to be able to get through that approvals process, which can be anywhere from $1 to $6, let's say. There's a range within the market. Then on top of that, you also have, which sits largely with the project developer, is the costs of insurance if you're looking to get insurance coverage, which you need to have under Corsia for those credits to be Corsia eligible until they have their corresponding adjustment in place. That
Yep.
can be depending on the country you're operating in. And many of these countries are developing and emerging economies. And so there is a level of, from an insurance
Country sovereign
perspective,
risk.
thinking about the sovereign risk or, I guess sovereign autonomy as we're thinking about the resource base. But from an insurance perspective, they'll be thinking about it through that risk lens that could add let's say $5 to that. So the question then becomes, are you getting a price in the Corsia market that is $10, $12 more than the cost of production of your credit, or that you could access in the voluntary market? And I think often what people are faced with is that it's really about liquidity in terms of being able to move those credits and for them to be able to be used in a number of different markets. But that's obviously
The
a pretty
fungibility.
significant additional expense, and an additional expense that you need to be fronting before you're selling those credits, because often that's a CP of someone's offtake agreement with you in the market. And so it's kind of interesting because I think if you're a country and you're thinking about where you set those levels, you're obviously looking at what your peers are doing in the market, but you're not necessarily thinking about, what are people paying for these credits or willing to pay in the market? And you need all of those numbers really to be lining up
You need all
for
those
it
numbers.
to work in the system. And I don't know that that's working, because there's obviously a number of different interests. People are holding different levels of information, the kind of timing of when you need to look at that. I think some of the expectations around the prices that people are willing to pay don't necessarily kind of reflect the realities. And that's just taking into account like cost of production, the fees you pay, and the insurance. But there's also, how do you engage in governments? What does that look like? The timeframes, all of those sorts of things, the roles that increasingly lawyers are playing within that process. We do a lot of due diligence that involves also looking at the policy and legislative context in which these credits have been produced. So there's a lot of complexity that's coming into that as well that needs to be solved. I think people are starting to get there, but obviously it's a work in progress.
It is very much a work in progress. You make some really good observations. I want to come back to the CP, the conditions precedent piece, secondly, but as it relates to this price, I was at a roundtable with during the Singapore Air Show was on a couple of weeks ago, maybe 3 weeks ago, and I was working with an OEM, and it was revising them and a number of airlines and also some government folks that were in attendance, and we raised this topic because we had a financial institution that said, hey, listen, there's no natural contango here, or like we can't go in there and finance these projects because there's, quite frankly, no visible demand signal that's making it into the market. And airline folks were like, no, the demand is very, very real. It's there. But the reality is it's latent and it's not well crystallized. It's not well defined. It's not seen on a screen. There's no bids on an exchange right now, right, as it relates to Corsia eligible units, even though more suppliers just recently entered the market. Most of the transactions are being done bilaterally, and those price signals are effectively opaque by the very nature of the transaction. And so the demand is not yet being distributed, or the signal is not being distributed into the market to affect the pricing. Like you said, there's a corresponding adjustment. There's the underlying instrument, sort of like the generation costs of the carbon credits. And so effectively you've got this to your point, like airlines are playing chicken. There's this chicken and egg dilemma that's actually emerged in the market as to, who's going to move first. And I think as we start to approach that compliance window, there's going to be that shift. And it's, I think this feeling around the lack of supply because of this lack of capacity building and these huge bottlenecks as it relates to CAs is going to be materially felt. Today, coming back to kind of the analogy that you had around ACCU markets, where the market is on spot, fairly well supplied, but long term, it doesn't look like to be the case. And Corsia is very much like that. There's 30 million tons, or give or take, in the market at the moment, and airlines are essentially starting to pick off at the sides. But as soon as there's a big influx of demand, that supply just evaporates and everything goes out in the forward curve, and you start to see the pricing, certainly across futures, is my thesis. So that kind of brings me now to, I'd love to get your comments, and then I want to come back to conditions precedent.
So I think the interesting piece is, if you look at the market now and the chronic undersupply, does that actually start to influence whether or not the scheme will be viable? And I think that
I haven't even talked about that. That's the boogeyman.
That's the conversation that's here at the moment. And so I think there's an interesting question in terms of how do you actually create the foundations of the market in a way that ensures its viability. Because I think at the moment, many airlines are looking and saying, yes, we are taking this very seriously. But even if we were to go and buy all of the supply that we needed. It doesn't exist. And so I think there's an interesting reframing and I think a serious conversation that needs to be had about how do you actually get those fundamentals right? And so is that a matter of the airlines together and, supported by, it's not going to be IATA who's doing it themselves, but is there a way to actually invest in the capability building on the supply side? Because they need to start investing in unblocking it because
I,
that
I
is
can
going to
tell
become a
you,
really live issue.
I can tell you IATA's already doing that. But their ability to influence is going to be limited. Like, it's a membership organization. They're representing the airlines, and what they can do is effectively lobby. They've recently hired some really great personnel to be able to try to do that and provide that influencing. They're not parties to the transactions, right? And they're effectively representing the voice of their members. And they have obviously a vested interest to see the system succeed, because the alternative is essentially an erosion of a market-based mechanism that took decades to get off the ground, and essentially going back to this patchwork quilt. And so there's all these tensions inherently within Corsia. It's a very interesting market. And I think 26 will be absolutely a critical turning point in this market, and obviously 2027. The view is essentially that the short squeeze will be realized in that second half of next year, as airlines start to engage much more actively in the market across spot, etc., and the ability, if it's there, to hedge. But so now let's kind of pivot to the front part of that the front part of the curve, effectively where airlines are looking to structure these offtakes with counterparties. There's obviously a question around the actual delivery of these credits, and therefore you mentioned that the CPs that are written into the contracts. Can you give us a little bit of context around some of these carve-outs that are there, obviously to protect the airlines around the delivery of course the eligible units? Because obviously they're trying to they're very risk averse by nature, but they're also trying to act rationally in this market, given the fact that there's limited supply. They're trying to go out on that forward curve and try to contract for those credits, but there's uncertainty around the CAA. So how does that represent itself in legal terms?
Yeah. So, I mean, obviously, I'm only seeing some of the deals that are getting done in the market, or like often happens, we're hearing about those deals
Mm-hmm.
in the market, but not necessarily kind of citing them ourselves. I think there are a few
Yeah.
things that are happening. I think increasingly what we're observing is airlines doing much more due diligence, not just on the projects that they're buying from, but also looking at and needing to get support around doing a level of analysis around that policy and legislative context in country, which helps them understand, where some of those risks may be for those projects and kind of forming an understanding of what that looks like, which is quite interesting because many of these projects will have insurance in place as well. Buyers are really kind of doing their own due diligence and their own homework in terms of thinking about what this looks like and the environment in which those projects are operating, understanding how well they're kind of operating country. Do they have good relationships with the government? What does that look like? As well as, the policy framing, the structures, the systems, etc., that exist in those countries that mean that the government will actually be able to progress the project through to
Yeah.
be able to apply those corresponding adjustments. So I think that's one thing we're starting to see, which is a new angle to due diligence that's happening that people are really interested in. I think
But
the other
can I
thing that
actually
we're
double click
starting
on
to
that one though,
see,
Steph?
and is
So just on that point, it seems that then that creates an opportunity for the very sophisticated airlines who can actually do that due diligence themselves, but it creates effectively a tale of two type of airlines, the haves and the have-nots. So the airlines that are under-resourced, the smaller carriers that have that exposure, but not necessarily the teams, the know-how, etc., they're at a disadvantage. So they're just playing the waiting game, trying to learn by seeing and doing, like seeing what other people are doing, I should say. And the bigger carriers are effectively taking
that's
the
also
low-hanging
where
fruit.
advisors come into the market as well. So I think
Yeah.
people are leveraging and getting people that they know have this level of expertise in the market to support them as they're understanding what that might look like in country, because it's probably not a natural skill set, even as people are building out strong teams, as we know, not just for the airlines, but for many companies and buyers. Often they outsource that due diligence, or they get a level of support as they do due diligence, because, there is something in having an advisor who's doing that every day and knows that system really well. And so I would say even those who are well resourced would be relying on and looking for some external support. But obviously,
Okay.
not everyone has the capacity to do that in the same way. But so I think the other interesting component is as we think about, and you know this as well as anyone, as we think about companies and where decision making around spending sits. And so what's really interesting is like, how do you get your internal treasury across the line on these sorts of deals and structures? Because it's quite different from the level of risk that people might have needed to address in the past. And increasingly, we've seen a lot of these functions kind of be centralized into central treasury departments or
Hmm.
finance departments and procurement processes. And so I think there's an interesting piece there, which, a lot of this is to your point around like, what are some of the CPs, the conditions precedent that we're seeing in contracts, or how are people thinking about it? I think often some of the contractual terms are also reflecting what people need to include to be able to get those who are less familiar with the market and less familiar with the context across the line to actually get those contracts signed, which I think we often underestimate how influential that is in terms of where things really land from a contract perspective, and whether that means people, what level of risk they're willing to take, how, spot deals are much easier to do than forward offtake agreements, for example. We've seen that drive things of like fixed versus floating prices. There's a level of complexity that people can engage in and maybe not willing to engage in. But I think a really interesting
Yep.
component that I see, and I've seen really different perspectives on this playing out, is who the counterparty is. And so there's always a really interesting question about who you're actually contracting with. And I know in your former life as well, this is something we've talked about quite a lot in terms of, who were you willing to face and front in
To
a
face.
transaction? And particularly if you're a
Yeah.
large corporate, what does that look like in terms of counterparty risk that you're willing to take on? If you're working with a small project developer who's working in a developing country, is that within your comfort zone? Is that within your risk tolerance?
Short
For
answer is
some,
no.
it
They
will
just
be.
don't, they just lack the credit rating, right?
Yeah.
And they lack the
And,
sophistication
and so,
oftentimes.
yeah. So one of the things we have seen is a lot of the intermediaries who may be financial institutions, for example, sitting in between, and they're really the ones that are facing the airlines in doing these transactions. And that's quite interesting because those intermediaries don't have a direct line of sight to the delivery of the project or oversight on how that's being delivered and managed in country, which is kind of interesting because you're solving for some risks, but you might be opening yourself up to some other risks in that market as well.
Completely.
But also looking
But at
at,
least they can face the
people.
shortfall penalty kind of piece as
Yeah.
well, because the FIs have got the balance sheet. So if there's a default, they're going to cover it with a financial cover or a hedge in the futures markets, if assuming there's sufficient open interest and liquidity. So, their risk teams will only price it so much,
And they're
but at
building
least they're
books, right? So they have a few different projects
slowly.
that they would be, yeah, where
Yeah,
that
I
supply
talked to a number
exists.
of FIs about this, and they still struggle. They understand that there's X amount of supply. They could do the origination piece themselves. Oftentimes, they might not be long carbon, so some of that institutional kind of knowledge has disappeared. But they're competent enough to be able to structure it. What they struggle with is this decouple between the spot and then the futures markets. There's just not a natural contango that they can apply to say, okay, we'll buy this, warehouse it, and then there's a cost of carry plus effectively the upside, and we'll be able to hedge some of that out on the futures. It's not yet there. In fact, the futures is effectively sold off just recently. So they're kind of struggling. And again, I think that oftentimes, the airlines would prefer to face those financial intermediaries, but there may not be so many willing parties right now coming to the table just yet, because the economics may not stack up at the current price levels. So it is a really interesting time to be in this space. And like you said, I think it comes down to those expert advisors helping you to navigate the complexity of these markets, to be able to provide some form of capacity building, consensus building to ultimately try to create these unlocks. And you've got, the way we think about it is that any Corsia transaction, as well as Article 6 transactions for that matter, don't just have a buyer and a seller. There's also the host country who's a tripartite to these transactions. And that's what ends up making the deals tricky. Anytime you have three people trying to negotiate something, it's always a little bit difficult.
I mean, I'm interested in your views around this. When a lot of the insurance products came into the voluntary carbon market in particular, or verified carbon market if you are on that train, but I think what was interesting is many people who were looking at these insurance products were looking at them and saying, is it better that I take out insurance, or should I be thinking about how I build a diversified portfolio? And I think there's an interesting question when it comes to Corsia as well, because, yes, obviously there's a requirement around needing to have insurance if a corresponding adjustment hasn't been issued. So that period of time between when you have your LOA through to corresponding adjustment. But what's interesting is that doesn't necessarily solve for the kind of non-delivery risk of what that looks like
Yeah.
from a portfolio level. But at the
Yeah.
moment,
And
one of the
insurance companies
challenges
aren't
is
able to build
there's
out their
only a few
own.
sources of supply, right?
Exactly. And also the insurance companies, when they're pricing that risk and that policy, they're doing a financial settlement for most parts, right? Because they don't have the ability themselves to be able to build out that inventory to do a replacement as like for like. Like ideally, they would deploy their balance sheet, provide that initial liquidity to the market, build that out, and then be able to price policies to the different participants out there. But they just haven't been able to, because again, there's this bottleneck right at the beginning of the market supply. It's an interesting space, the insurance space. I spoke to a number of insurance companies earlier this year. They were buoyed, and maybe they're talking their own book, but they were buoyed by recent developments in the market, with new countries coming to the market effectively and issuing supply, and they see more sources effectively than there was certainly last year and a year before, where it was just the archery credits from Guyana as the only game in town. But now you've got Laos and you've got Malawi and you've got a bunch of different countries actually now providing that supply. And I think that they were buoyed by that, effectively creating a little bit of additional liquidity to the market so that they can start to underwrite these risks. How
It's
do you
definitely
see it
starting
from the
to ramp
insurance
up.
guys?
There's a lot more supply that is coming. Yeah, it's a good question. I mean, I think what's interesting is, particularly if you have an insurance product that is paying you out in a financial settlement, the question is, what risk are you really trying to cover? And so are people using insurance in the market really to be covering their obligations to potential buyers in the circumstances that there's non-delivery and they have a financial penalty that they need to pay? And the question is, really, does the insurance actually cover those costs, which I think is a question is going to be determined by the policy. I think what's interesting is, to the point that you were making, like, if there is an insurance product that was underpinned by a diversified pool of Corsia eligible credits and you can get replacement from within that pool, that would be a hugely valuable product in the market. But I don't think that that's going to come through an insurance product. That is kind of why I guess I was asking that question around the role of diversification, which is, if someone can build that pool and they have certainty around that supply, that's a pretty interesting position to be in the market, because particularly for those credits, because there is that pathway in the time period between getting your LOA and that corresponding adjustment, it just gives you a lot more confidence in terms of being able to supply into those contracts and to take on contract terms where there may be penalties that otherwise you wouldn't be able to meet, which kind of takes us back a little bit to talking about the role of financial institutions. But so I think it's an interesting, in my mind, I think the insurance is important, but I wonder if there is a level of false security that it might provide of what the implications are if that project doesn't progress all the way through to receiving its corresponding adjustment. And so what does that mean for, as a project developer, as a country, as a buyer within that market? How do you think about managing for your exposure? And I think it's a little bit more complex than just having the insurance in place. I think it provides people with a level of comfort, but the question in my mind is, does it actually solve for some of the risks that you might be exposed to? And so that's where I think a lot of those conditions precedent that are being built into contracts and the way that people are contracting and who they think is their counterparty, all of that stuff becomes really important as well.
Yeah, I completely agree. Can I posit an potentially unpopular take, certainly with my airline clients? But I think that the thing that's missing is the non-compliance penalty. I think that once these make it into effect, and it may not happen in pilot phase, but once a country understands what the cost or what the penalty of non-compliance is, they will be motivated to provide that or distribute that price signal into the market, to go out there and buy below the compliance cost. And B, insurance companies can actually come in and essentially start to write tickets against that price. right, as well. So you'll actually start to, I think, see more unlock in that. And it keeps coming back to these tripartite kind of players in any transaction. The governments are not just exporting tons, right? But they're also signatories to ICAO. And they're the countries that effectively ratified this system. So they have an obligation, in my mind, to also hold up the rear effectively, right? They can provide the supply, but they can also actually enforce this system. And that's been lacking to this point. And it seems that that's the pressure cooker that's required in order to spark this market and kick it off. Because you talked about private sector actors, project developers, they're risk on, they're willing to engage in countries despite the lack of clarity around the policy signals around, the issuance of their CAs, et cetera. They're still willing to deploy capital and still willing to engage. Obviously, if there was a clearer pathway, they would unlock even further. The trading community, the advisory community, the exchanges, they're all trying to push and try to manifest this destiny. But without, I think, the penalty piece, I just think this market continues to sort of languish just because we don't have any upper bound around what it means for compliance. And, that to me is evident. I think I will point out the elephant in the room that there won't be a consistent price across the board. Some countries might choose 50, some might choose 30. And so now it's the lowest cost of those two effectively where it's at. And, what's your takes on that, given that it is an unpopular opinion? I know many of my clients won't like me for saying that.
I don't know if that is an unpopular opinion. I mean, I think
I raised it with one client and she said, absolutely no chance that we're going to support that thesis. I was like, okay, I'm trying to help.
So I don't know that they would actively support it, but I do think like the overwhelming, whenever you hear about, you ask people, what do you need to invest? What do you need to be moving as a corporate on this, et cetera? Everyone always says certainty. And so, that is the answer to that question around certainty in terms of what does this actually mean for the scheme? So yes, it might be unpopular in terms of the dollar figure that's attached to that. But I think having that certainty, it means people's decision-making around what that looks like becomes easier, right? Not only is there a mechanism in place, there's a penalty if we don't meet our requirements. It makes it very easy to then make the case for that action. What I think is interesting is the dynamic where some countries move and other countries don't move. And so what that actually means, because I think, there are some, and like UK, for example, was one of the first to kind of come out and put a dollar figure on it. Has been piecemeal and I think will remain piecemeal, to be perfectly honest. But I do think that there is something in having that level of certainty around how this is going to operate that really starts to drive some of that action. And I think what's really interesting is that there are other areas where countries are going to need to move in relation to their NDCs as well. And so they're starting to put in place the policy settings and thinking about what this looks like. It's kind of a natural extension of where that heads. Maybe not for all countries, and there's obviously some notable exceptions that we know when it comes to climate policy, particularly at the moment, where some of the major airlines are kind of based. But yeah, I don't think it's an unpopular opinion. I think there's a lot of people who are asking that question of when is that coming and what does that look like?
Yeah. Cool. That's good to know. Thanks for reinforcing that. I felt a little bit, I was like, it's logical, right? And got told, we don't want you to do that. Okay, cool.
Yeah, obviously it's better if you don't have to pay a penalty. That's your ideal circumstance.
Completely. But there's the boogeyman, quite frankly, with the EU as well, right? That's always been the case in terms of their role around, okay, stop the clock. Like if this is not working, then any airline coming into the EU airspace is going to be subject to the EU ETS. And that's got a much higher price than where the current market is. And so, I've spoken to many carriers off the record who said, yeah, we don't, what's at the deterrent is that we don't want that. And we don't want a patchwork quilt of compliance systems where one's a tax, one's an allowance, one's, something else, a hybrid system, whatever else, and just different price points, right? Like the implementation of that logistically is a nightmare. And they just, the whole point of Corsia was to create one level playing field for the entire sector. And I think that's certainly appreciated. And, I think that there are many players in the space who, even though, and I'll say it, some US carriers, some, not all, even though the lack of policy direction in the United States, are interested in advocating for the continuation of Corsia and who may actually participate on a voluntary basis, even though there's a lack of clarity within their regulatory purview. And I'm pointing to the FAA in that case. And that's because they know that the alternative is a much worse solution. or outcome?
While we're on unpopular opinions, I have a question
Shoot.
or something that I've been thinking about. I don't know that it's actually that unpopular, but I mean, one of the things that I often reflect on as we think about the Corsia market is how long does Corsia exist as a separate market to what's happening with Article 6? And so I think that's one of the other questions that is on people's minds is obviously Corsia has, it's a subset of credits that are eligible of particular methodologies from particular registries, and it has this architecture kind of set up. And then alongside that, it also is using the Article 6 infrastructure when it comes to needing those approvals and what that looks like. And I think to your point around how do all of these systems work together and what does that look like, that's something in my mind of saying, well, actually, for how long do these, I guess, kind of side systems continue to exist? And is that just because Article 6.4 in particular has taken longer than was originally anticipated really to kind of be up and running? But it's a question that I think is live in my mind, similarly alongside, things around, all the bilateral agreements that came through in 6.2 or Japan having the JCM that has its own kind of set of criteria that applies as well. Are we going to get to a point where everyone's kind of using the same common infrastructure? Because essentially you're looking to source credits from the same pool of supply. And a lot of that framework has been really set around managing the demand side and I guess the kind of claims from the demand side and how they think about meeting their obligations. But is that going to shift to where the supply side is setting that a little bit more around the framework? But anyway, I'm interested in your views of where it's going. I kind of oscillate. Does it all come together? Does it remain separate?
So that's a fabulous question. So it depends who you ask, right? So I had a chat with Perumal Arumugam, is his last name. Everyone knows him as Perumal, right? So he's like Cher, like one name person, and he's at the UNFCCC, and he's the guru there, right? Around the Article 6.4 piece. I interviewed him for the other podcast, Carbon Exposure. And that episode will come out in a couple of months. And obviously he's talking in his own book here, but he thinks, to your point, that 6.4 becomes that well of supply. And because obviously ICAO and UNFCCC are UN sister agencies, that there's a natural lead in there. And ultimately the 6.4 ERs will become the de facto supply pool for meeting Corsia. And he thinks that, first issuances happen this month or next month, and then you'll actually overcome this bottleneck of supply because of the system. Great. I hope he's right. I hope that's the case. I hope there's adequate supply coming through under 6.4, and that some of that supply then finds its way into Corsia, and there's this fungibility around this kind of universal currency. I just think that bottlenecks there are really significant too, because you've got essentially one governing body doing the issuance, essentially. They don't call it issuance, but that's essentially what they'd be doing. We've seen it under the CDM that the executive board was always a constraint in terms of that supply. I think that there's going to be questions around integrity side of the market, because on the VCM side, the verified carbon market, which, subscribe to that one. So shout out to Rich Gilmore on that one for coining that term. The market's done a lot of reflection and integrity, like reforms, right? But on the UNFCCC side, I don't think that has been done quite effectively. This transition from CDM to Article 6.4, there's still some methodologies that are questionable. And I think that that's going to be another area for folks in the integrity debate camp to attack. So I think that'll be interesting. But to your question, I don't think it's just in ICAO's best interest to limit it to one source of supply. And I haven't spoken to the ICAO folks for quite some time, but I remember speaking with Jane Hoope, who was the deputy secretary there for many years. Her view was like, look, you guys are the market, and we need to have multiple sources of supply, like this kind of optionality. Because if we restrict it to one source, if that well is effectively tainted, then we're screwed. And so that's why the technical advisory body has just opened up the doors to so many different programs to provide that supply. Some may be easy, some may not be easy, but ICAO's view is like, we're not going to pick winners. And so I think into the compliance phase, the CP2, you'll see everybody being effectively eligible, subject to meeting the criteria for eligibility, right? So they'll have the vintage piece, the project start date, and then the methodological sort of carve-outs that they have. And the 6.4 stuff will be included. The really interesting one and depends who you talk to here as well, is under Article 6.2. Effectively, we've seen a lot of developments there, and a lot of essentially these bilateral agreements been struck to create these pipelines of supply from Ghana to Singapore, or whatever it might be. Some people think that those units are fungible and that they're tradable. Right? That buy side country may then be able to export some of those credits in a multilateral type of framework. If you talk to Peter Zaman from HSW, he doesn't think that's the case. He knows his stuff pretty well. I tend to agree with him. I think that that's a one-way transfer. I don't think that that's a back channel. I wish it was. I think the Singaporean model was thought out to be like a hub and spoke model, where you create agreements with a multitude of different countries, import those credits, and then have them eligible for your own compliance system. But if you had a surplus, to be able to export it to maybe other buy-side countries, that hasn't yet been codified. It may very well be, but to date, it's not. To your question, I think 6.4 does become a pool of supply. I still think that the voluntary or the verified standards, like Vera Gold Standard in particular, continue to carve out a nice big niche. I think art trees at a jurisdictional level will continue to be optimized. And it'll just be a patchwork of different credits coming through.
I think in my mind, it is a variety of different sources. The question is, what does that kind of funnel look like? And so I think, we need to leverage as much infrastructure as we have while ensuring that there are minimum quality and integrity standards kind of met. I mean, it's very interesting about that question of the kind of on trading of 6.2 credits. And I think ultimately it's going to depend on how those agreements have been established and what that looks like. There's this whole
Devil's in the detail
accounting infrastructure that sits behind all of these things that I think is, incredibly important, and people are still wrestling with that in terms of really niche things. Well, not niche if you're spending all of your time in carbon accounting world, but, as you think about when does first transfer take place? And so when do you need to be reporting these things? When do you need to make sure that you're submitting your biennial transparency reports, and how is that all tracking through? There's a whole world around that reporting that is quite intricate and important to get right. And a lot of the success, not only of Corsia, but a lot of these systems is going to depend on people's inventories, people's registries, the interoperability of registries. Obviously, there's work happening with the UNFCCC at the moment around that registry architecture, the reporting functions in terms of what goes back to the UNFCCC things. There's a whole bunch of boring, I guess, administrative components to make sure that people get right for this system to actually work really well. And it's important that they get it right, because I think that's where we'll start to see whether these things kind of succeed or fail.
I completely agree. Yeah. And it is really important. I think we're seeing this paradigm shift. I'd also like to get your thoughts on this. But effectively, when we touched on it, right, with host countries' responsibility for not only the exporting, but also potentially, as it relates to Corsia, enforcing the compliance penalties. It's this question of sovereignty that is now material to carbon markets, where in the voluntary side, it was superfluous effectively, but now it's a material thing. I talked to Chandra, a singer from the World Bank, and a couple of years back, and when the last time I spoke to him, he was still on this one, and I really like it. But his view was essentially the paradigm has shifted, and under Article 6, the sovereignty will not be challenged. Countries will become the issuing bodies. The standards may still continue to become just the certifying bodies, but effectively this dual role that a Vera and a gold standard have played historically, which is both the certification, so defining those outcomes, monitoring, around baselines, the MRV, and doing the issuing at the registry, may shift insofar as, again, what are airlines looking to buy? To EUs. They're looking for that corresponding adjusted unit. If you've got it as a VCU, it's just only fungible or deliverable into voluntary. But once you have that CA, it's fungible across multiple different markets, Corsia or potentially other sources. And so his view was that role of the government to export those credits, to borrow that word from you, is going to be akin to the issuance. So I think we're going to see a lot of that sort of tension being born out over the next few years. And to your point around registry architecture, it's not just the Article 6.4 registry that's now in kind of being built out. It's going to be the national registries and how they intersect with the traditional voluntary registries, the APXs of the world. Now ICE is entering the fold, and others. How do you see that?
Yeah, so I think what's interesting is there is a level of, control and ownership of the the process. And I think power that sits now with sovereign nations, particularly those supplying nations into the market, which I think is a pretty significant dynamic shift in terms of the market. Not all supplying countries are going to be equal in terms of the existing infrastructure that they have and their capacity to deliver that. And so, I think this idea that they'll take over those functions from kind of their own gold standard. I think what is more likely and what we're seeing happening at the moment is that they're utilizing that infrastructure and then they're adding on what they need to add on for the confidence for themselves. And so they will maintain a register as relevant that will draw from information that's available through their own gold standard and the other standards because, if we compare, say, the way that the market operates in Australia, the Australian government who is operating the Australian Carbon Credit Unit Scheme, they are doing the processes around the development or the analysis of those methods and ensuring that they meet particular criteria before methods are eligible. And then they also have the Clean Energy Regulator who's running the scheme and is doing that verification and analysis and making sure that they meet those standards before credits are issued. Not every country and very few countries are going to be able to do that themselves when we're thinking about the breadth of where a lot of, I guess, the carbon that is likely to be exported into the international market comes from. So the question is, how can they then leverage that infrastructure? And I think this is one of the questions that I have in my mind around Article 6 in particular and 6.4 is how do they support countries with that infrastructure for them to be able to go through those processes? Because at the moment, the opportunity, and this is what a lot of 6.2 has done, is they've drawn from and used the voluntary carbon market infrastructure. And then they've thought about what do they also need to meet from their own country perspective. And that allows them to kind of outsource some of those functions that are highly technical and that they wouldn't necessarily have the capacity or capability to service just for their own country. Maybe people start to do that on a regional basis. I don't know whether that's something that might evolve of kind of countries working together to have some of that infrastructure. Probably unlikely given it already exists. But I think that's the interesting piece. But then obviously there is that requirement to make sure that if they're using that infrastructure, that they have a record and they're maintaining what that means in terms of their own approvals, they're tracking it, they're linking it to serial numbers of credits that have been issued. They're then able to report through to that in their BTR. So it's an interesting hybrid system. And I think that hybrid is going to continue to exist because there's so much that actually goes into navigating that process for a carbon project to go from, just being an idea in someone's mind all the way through to its full implementation, its verification, going through all of the audit processes, all of those sorts of things, maintaining that MRV, getting the issuance. There's a lot in that alongside kind of managing that at a country level as well. So I think we'll continue to see a lot of that infrastructure used. And I think this is an interesting space where for many of those countries that are supplier countries who might not have that infrastructure in place already, it's very compelling to think about and use the well-established infrastructure that we have in the BCM rather than kind of going back to many of them might have been involved in CDM days. Yeah. Yeah. And CDM kind of moved from CDM into VCM. You saw a lot of projects migrate. You saw methodologies migrate and be updated. And now we've kind of got that next transition within that. But there's a lot that goes into, and I think, often that's one of the misconceptions in the market. It's like, it's actually pretty hard to get a carbon project across the line and to get through all of those steps in the process.
Yeah, I completely agree. And I think that there is that tension, I think, but there is a realization by many countries, as you said, that the architecture that's being built at the voluntary standards is really significant. And that role of certifying those outcomes is going to remain a key feature long term, or needs to be, in order to ensure that independence and that governance remains. I do think that there's tension at the registry piece because there's some really weird kind of movements around. Some countries will need a project to be registered in country first and then with the standards. Some will want it the other way. Sometimes you can actually have the outcome, which is the VCU or the VER, but then it needs to be then transferred into the national registry. And there's this kind of patchwork good. It's very much an inside baseball kind of thing. Only the people that are doing it every day understand it, and there's not a homogeneous sort of process that's across the board. So I do think we'll start to see that sort of unfold as the registry providers, the technology providers are starting to enter the fold and try to provide that technology. I think the astute ones will start to license their tech to countries, and you'll start to see maybe different systems interoperate over time.
It's also where I think countries that have a clear articulation of what their process and expectations are for people becomes really important. So, a country that says we have a 3-step approval process and this is what you need to do and this is when you come to us and this is when you go to and you use the voluntary market infrastructure. Having that articulation makes it much easier for people to navigate and know what they need to go through, but also to be really clear on when that kind of has and hasn't been met in the market, which I think is also pretty important. The other thing that I think is, particularly as we think about 6.4, like people aren't waiting for 6.4. Yes, the first credits are being issued, but a lot of this is happening now. And at the same time, where the Article 6.4 like infrastructure is being built and the foundations of that market and looking at what methods are happening. But at the same time, people are already starting to move. So I think it will be interesting to see not necessarily how they come together, but how they kind of operate together as that goes forward. Because, we're in 2026 and people are needing to use these Article 6 credits, towards meeting targets in 2030. You can't kind of wait another 12 to 18 months to know what that looks like.
Yeah. Okay. Hey, Stephanie, we could keep talking about stuff always. And I think people are just getting a glimpse of when we catch up for dinner and drinks. It's always really fascinating. I want to thank you as always for your contributions. It's always enlightening speaking with you. Any last words before we wrap? I know I've taken up an hour and 20 minutes of your time.
Just thank you for having me. And I think it's really great that you kind of provided a space through this Week in Carbon and also through the Carbon Exposure Project to really have these discussions in the market, because I think it's really useful for people to hear about and be able to delve into different issues and people to kind of hear from people working in the market about what's happening. So I think it's really great that you're offering that.
So I'm trying my bit to safe and welcoming spaces for people to have that community and those discussions for sure. Cool. Thanks, Steph. I really appreciate you. And to everyone that's listening, thank you very much for tuning in. We really appreciate you being part of the community and to listen. Please follow, subscribe, comment, and also just share the episode with folks if you found it to be really interesting. And then we'll be back next time. Hopefully Eddie's feeling a bit better and actually jumps back in on the hosting duties. So thanks very much, Steph, and thanks to everyone for listening. Cheers.